Right now, millions of people have money sitting in their bank's savings account. They log in every month and see a little extra money appeared. Maybe 50 bucks, maybe 200 bucks. It's called interest. Think of it like this. If you keep $100 in your savings account for a whole year, the bank gives you about 5 extra dollars just for letting them hold your money. Pretty nice, right? They think, sweet, free money for doing nothing. But here's the problem. That free money is going away. There's a group of important people called the Federal Reserve. They're like the boss of all banks, and right now, they're telling banks to pay you less. Your bank is already paying you less than they did last year. Soon, instead of getting $5 for every 100 you save, you might only get $3, or even less. And here's what always happens. By the time everyone notices and starts talking about it at work, the smart move will have already happened. You'll be late to the party again. My name is Richard, and I spend way too much time thinking about money. Not because I'm rich, but because I'm fascinated by why some normal working people end up with millions in the bank when they retire, while other people work just as hard their whole lives and barely have anything saved. What's the difference? Today we're talking about something called SCHD. Now I know that sounds like boring letters, but here's what it actually is. Imagine owning tiny pieces of 100 big companies like Home Depot, Pepsi, and Chevron. And every few months, those companies mail you a check just for being a part owner. That's SCHD in simple terms. There's a huge shift happening right now with where smart people are putting their money, and I promise, by the end of this video, you'll understand something that might sound crazy at first. Keeping all your money in a savings account might actually be the risky choice, not the safe one. I know that sounds backwards, but stick with me. Okay, before we talk about what SCHD is, let me show you how normal people actually move their money around, and why they always seem to be late. A few years ago, everything got really expensive really fast. Gas, groceries, rent, everything. That's called inflation. So the Federal Reserve, those boss people I mentioned, decided to make a change. They told banks to start paying people more money to keep cash in savings accounts. Suddenly, banks were giving you $4 or $5 for every 100 you kept there for a year. That's actually pretty great for literally doing nothing. So millions of people looked at that and thought, wait a minute, why would I risk my money in the stock market where it could go down when my bank will just hand me 5% guaranteed? So they pulled their money out of stocks and dumped it all into savings accounts. It made total sense at the time. But here's the pattern that happens over and over again. Normal people always move their money after the opportunity already happened. They're never early. They're always late. They put money into savings accounts after the rates already went up. They panic and sell their stocks after they already crashed. They get excited and buy stocks after they already went way up. It's like showing up to a sale after everything good is already sold out. And guess what? Right now, those Federal Reserve people have already started lowering rates 3 times this year, and they're not even done yet. The experts who track this stuff are saying savings accounts will probably keep paying you less and less over the next year or two. Instead of $5 per 100, maybe it'll drop to $3.50 or even lower. So here's my question for you. When everyone finally notices their bank is barely paying them anything anymore, where do you think all that money is going to go next? That's the opportunity. And most people will miss it because they'll wait too long. Now, let me tell you something that's going to sound completely backwards at first. The safest place you can keep your money might actually be the riskiest place long term. I know that sounds crazy, but hear me out. Imagine you keep all your money in a savings account for the next 10 years. Every month you check your account and you feel good. The number never goes down, it feels safe and comfortable. But here's what's happening that you can't see on your screen. Everything around you is getting more expensive, your rent goes up, your groceries cost more, gas costs more, everything creeps up in price year after year, but your savings account, it's barely growing. Maybe it goes from 10,000 to 10,300 over a year. Meanwhile, the cost of everything you need to buy just went up way more than that $300. Fast forward 10 years, you look at your account and think you were being smart and responsible the whole time, but then you realize something scary. You can't afford to retire. You're actually further behind than when you started, even though your account balance is higher, because everything got so much more expensive and your money didn't keep up. That's the hidden risk nobody talks about. You feel safe, but you're slowly losing ground. Here's what's really happening with your savings account money right now. When the Federal Reserve tells banks to lower rates, your savings account automatically pays you less. You don't get a choice. Your bank doesn't get a choice. The Federal Reserve is like the referee that makes the rules, and everyone has to play by them. So if your savings account says it pays you 4.5% today, that number will probably become 3.5% or lower within the next year or so. It's already starting. Let me show you what this actually means with real numbers that are easy to follow. Let's say you have $20,000 sitting in your savings account. At 4.5%, the bank gives you $900 over the course of a year. That sounds pretty good, right? Almost $1,000 for doing nothing. But hold on. Let's talk about what that $900 actually gets you. Remember how I said everything keeps getting more expensive? That's inflation. Right now, prices are going up about 3% every year. What does that mean in real life? It means if you wanted to buy the exact same stuff this year that you bought last year, you'd need $600 extra just to keep up. So that $900 you earned, $600 of it just goes toward keeping up with rising prices. Now you're really only ahead by $300. But we're not done yet. Now let's talk about taxes. When your bank pays you that $900, the government says, hey, that's income, so you owe us taxes on it. If you're in a normal tax bracket, they might take around $200 of that $900. So now you're down to $700 that you actually get to keep. Remember, you needed $600 just to keep up with inflation. So 700 minus 600 equals what? $100? That's it. That's your real gain for the entire year on $20,000. You really only got $100 ahead. That's 0.5%, half of 1% of real growth. Your bank made it sound like you were earning 4.5%. But in reality, after inflation and taxes, you barely moved forward at all. You thought you were earning 4.5%. But in reality, after prices going up and the government taking their cut, you only grew your money by 0.5%. That's almost nothing. And here's the scary part. That's when savings rates are still pretty decent. When your rate drops to 3.5%, which is coming soon, you might actually be losing money. Your account balance might go up a little, but what that money can actually buy goes down. You're getting poorer even though the number looks bigger. Here's how I like to think about it. Imagine you're walking on a treadmill at the gym. The treadmill is inflation, and it's always moving backwards, pulling you towards the back of the machine. Your savings account interest is like you walking forward, trying to make progress. When the interest rate is high, like 5%, you're walking fast enough that you actually move forward a little bit. You're making progress. But when the interest rate drops to 3% or 3.5%, the treadmill is moving almost as fast as you're walking. You're putting in effort. Your legs are moving. You're working hard. But when you look around, you're basically staying in the same spot. You're not actually getting anywhere. I learned this lesson the hard way, and it cost me years. Back in 2018, I had about $15,000 sitting in a regular savings account. Not even a high-yield one. Just a basic savings account. I felt so smart. I thought, look at me being responsible with money. It's safe in the bank. I'm doing the right thing. I'd check it every few months and see $15,000 sitting there, and it felt good. 3 years later in 2021, I looked at my account. I still had basically $15,000. Maybe $15,300 with all the interest I'd earned. I remember feeling okay about it at first, but then I started noticing something. My rent had gone up by $200 a month. Gas went from $2.50 a gallon to almost $4. My grocery bill that used to be $100 was now $130. Everything cost more. Then it hit me like a ton of bricks. That $15,000 in my account, it could buy way less stuff in 2021 than it could in 2018. I hadn't moved forward at all. I'd actually gone backwards. I was poorer than when I started. Even though my account balance looked almost the same, I was standing still while the whole world got more expensive around me. That was my wake-up call. So if keeping everything in savings is actually risky over time, where should you put some of it? That's where SCHD comes in. Now, let me explain this in the simplest way possible because it's actually not complicated at all. SCHD is like buying a tiny slice of 100 different big companies all in one purchase. Instead of you having to pick one company and cross your fingers hoping it does well, You automatically own a little piece of over 100 companies. It's like, buying a variety pack of chips instead of just one flavor. Now, these aren't the exciting, flashy companies like Tesla or Apple that everyone talks about. These are the boring ones, the ones that have been around for decades. Nobody gets excited about them, nobody's posting about them on social media, but they're super profitable and they've been around forever. And here's the best part, they share their profits with the people who own pieces of them. That's you if you own SCHD. Here's how the checks work. When a company makes profit, sometimes they decide to share some of that money with the people who own pieces of the company. That's called a dividend. Think of it like a thank you payment for being an owner. It's like if you owned a pizza shop with your friend, and at the end of the month, you split the profits. Same idea, just with big companies. Now, here's the part that confuses a lot of people, and it's really important you understand this. If you go online right now and look up how SCHD has performed over the last year or two, it looks pretty bad. The price basically went nowhere. Maybe it went up 1% total. Meanwhile, the overall stock market went up way more, like 10, 15, 20% or more. So people look at that chart and think, this thing sucks. Why would anyone buy it? It's a loser. Let me explain why it looks bad right now and why that might actually be the exact reason you should pay attention to it. This is where it gets interesting. The reason SCHD looks bad right now is actually really simple. SCHD owns boring companies that make steady money year after year. They're not the exciting tech companies that everyone's obsessed with buying right now. When everyone wants flashy, fast-growing companies, the boring ones get completely ignored. Nobody talks about them. Nobody cares. Think about it like high school for a second. There's always that one kid who's super popular, right? Everyone wants to sit with them at lunch. Everyone wants to be their friend. Everyone's talking about them. That's like tech stocks right now. Artificial intelligence companies, electric car companies, everyone wants them. So the price keeps going up and up because everyone's buying. Then there's the other kid who's not popular at all, kind of boring, shows up, does their homework, gets good grades, minds their own business. Nobody pays attention to them, nobody talks about them. That's SCHD. But here's the thing you need to understand. Boring and unpopular doesn't mean bad. It just means nobody's paying attention right now. The boring kid might actually have their life way more together than the popular kid. Here's what might surprise you, and this is super important. Just because something went up a lot recently doesn't mean it's a good investment now. And just because something went nowhere doesn't mean it's bad. Actually, in investing, it's usually the exact opposite. The stuff that already went up a ton, that's expensive now. You're paying top dollar. The stuff that did nothing and everyone forgot about, that might actually be on sale. It might be cheap. Think about buying a TV at Best Buy. Do you want to buy it on Black Friday when everyone's fighting over it and it's full price? Or do you want to wait until January when nobody wants it anymore and it's 40% off? Same exact TV, but one scenario you're paying way less. That's what's happening with SCHD right now. Nobody wants it, so it might be on sale. Let me tell you a story that cost me a lot of money. Back in early 2021, everyone was talking about these exciting growth stocks, companies that were going to change the world and disrupt everything. And they were going up like crazy. Some were up 50% in a year, some up 100%. I even saw some up 200%. Everyone at work was talking about them. People on the internet were getting rich. I felt like I was missing out big time, like the party was happening and I wasn't invited. So I finally caved. I bought some of those exciting stocks right at the top, right when they were most expensive, right when everyone else was buying too. And guess what happened? Within 6 months, those stocks crashed hard, down 60%, down 70%, some even more. I lost a ton of money. It was painful. Meanwhile, those boring dividend stocks like the ones in SCHD, they just kept doing their thing, chugging along. Didn't go up much, didn't go down much, just kept sending out checks every 3 months like clockwork. The people who owned them didn't get rich quick. They didn't get to brag at parties. But you know what? They also didn't lose half their money when everything crashed. They just kept collecting checks and sleeping well at night. That's when I learned the hard lesson. Popular and exciting usually means you're late to the party. The opportunity already happened. Boring and ignored usually means you're early. You're getting in before everyone else notices. That's where the real opportunity is. So why am I making this whole video telling you to pay attention to SCHD right now? Because of what's about to happen next. And I think most people are going to miss it until it's too late. Right now, there's a massive amount of money sitting in savings accounts. We're talking trillions of dollars. just sitting there. And that money is about to start moving, not all at once like a stampede, but slowly, like a river changing direction over the next year or two. And when it does start moving, SCHD is probably going to be one of the main places all that money flows into. Here's why. When savings accounts start paying people less and less, people wake up and start looking for other ways to make their money grow. It always happens. Millions of people will log into their bank one day and think, wait a minute, I'm only getting $3.50 per hundred now? That used to be $5. That's barely anything. And then they start looking around. They start asking, where else can I put my money that'll actually pay me something decent? That's when they discover things like SCHD, things that pay them regularly and also have a chance to grow over time. This isn't some new theory I made up. This is a pattern that's happened over and over throughout history. In the mid 2000s, when savings account rates were really low, tons of money poured into dividend paying stocks. People wanted income, so they went looking for it. Same thing happened in 2008 and 2009. When rates dropped to basically zero after the financial crisis, people eventually started moving their money into investments that actually paid them something. It took a while, but it happened. The pattern is always the same. It's predictable. When savings rates are high, people love keeping cash in the bank. It's easy, it's safe, it pays well. Why do anything else? But when savings rates fall and fall, people get frustrated. They start hunting for better ways to earn money on their money. They look for what's called yield somewhere else. And we are at the very beginning of that cycle right now. Most people haven't figured it out yet, but they will. And by the time they do, the opportunity will have already moved. But here's what most people miss, and this is the key to everything. They wait until the shift is already obvious to everyone. They wait until their savings account is barely paying them anything, like 2.5%. They wait until SCHD already went up 20% or 30%. Then they finally buy it because now everyone's talking about it and it feels safe. But at that point, they're late. They missed the opportunity. The best time to buy was before when nobody cared. The smart move is to see the pattern coming before it's obvious to everyone else. Right now, in this moment, savings rates are still okay. Ish. They're not terrible yet. Most people aren't worried or panicking. They're not scrambling to find somewhere else to put their money. And that's exactly why right now is when you should be paying attention and positioning yourself before the crowd shows up. Let me show you why SCHD makes sense right now with simple numbers. SCHD pays you about $3.7 to $3.9 for every $100 you own each year. That's already pretty close to where savings accounts are headed as rates keep dropping. So in terms of how much you get paid, they're becoming similar. But here's the massive difference that changes everything. SCHD's payments have grown by about 12% per year over the long term. Let me say that again. The checks they send you get about 12% bigger each year on average. Your savings account? The payment just goes up or down based on whatever the Federal Reserve decides. You have zero control, zero say in it. They can cut it whenever they want. With SCHD, the companies are actually trying to pay you more each year because they want to attract investors and their profits are growing. Think of it like this, and this comparison really helped me understand it. A savings account is like having a job where your boss completely controls whether you get a raise or not. Some years your boss gives you a little more money. Some years your boss actually cuts your pay. You just have to take whatever they give you. You have no control. That's your savings account. SCHD is like owning a small business that tries to pay you more every single year because the business is growing and making more profit. The business wants to keep you happy because you're the owner. Which one would you rather have? A boss who randomly changes your pay based on rules you can't control? Or a business you own that's designed to pay you more as it grows? Here's the uncomfortable truth that separates people who build wealth from people who stay broke their whole lives. Rich people buy things when nobody wants them and they're cheap. Poor people buy things when everyone wants them and they're expensive. It's that simple, but most people get it backwards their entire life. Everyone wants to buy the thing that just went up 50% because it feels safe. It feels smart. Look, everyone else is buying it, so it must be a good idea, right? Wrong. Dead wrong. By the time something is obvious to everyone, by the time everyone agrees it's a good investment, you're already late. The real opportunity was 6 months ago or a year ago when it looked bad on the chart and nobody was talking about it. That was when you should have bought. SCHD looks bad right now on the chart. Nobody's making videos about it. Nobody's excited about it. Your coworkers aren't talking about it at lunch. And that's precisely why I'm making this video right now, because this is when the opportunity is.